Welcome back, real estate moguls. Today we're diving into the diverse world of real estate investing, exploring the different asset classes that could reshape your investment strategy. So, whether you're a seasoned investor looking to diversify or a newcomer eager to understand the landscape, this video is your gateway to unlocking the secrets of residential, commercial, industrial, and specialty real estate. Join me as we navigate through the distinct characteristics, risks, and rewards of each asset class, empowering you to make informed decisions and elevate your real estate investment game. I'm Dr. Brown. I have 13 years experience in real estate investing, and last year, my company did $953,900 in real estate. So today, we are unlocking the different asset classes that could reshape your investment strategy. So grab your notepads, hit that like and subscribe button, and let's embark on the journey through the fascinating tapestry of real estate asset classes. It's time to level up your investment knowledge, so let's get started. And I'm going to share my screen with you so that we can look at all of the different asset classes. So today we're going to look at real estate asset classes and dive into the different asset classes of real estate investing. So first, we're going to look at residential real estate, and this includes single-family homes and long-term rentals of 1 to 4 units. So this includes condominiums, townhouses, and multifamily properties like duplex, triplex, or fourplex. Residential real estate is often considered a stable and accessible entry point for many investors because you can actually purchase residential real estate 1 to 4 units and live in one unit, and then rent out the other units and collect rent so that they pay your mortgage down. And you only have to bring 3.5% up to 10% of the purchase price to the closing. And that is in consideration of your credit score. So if you have a credit score of 580 and above with the FHA loan, then you would bring 3.5%. But if you have a credit score that's less than that, then you would have to bring a 10% down payment to the closing. So that is long-term rentals. And we also have short-term rentals, so because some people buy these single-family homes and they turn them into short-term rentals. So this involves leasing a property for a brief period, typically ranging from a few days to several weeks. And this can include vacation rentals, Airbnb properties, which are very popular, and other accommodations for travelers. Now, for this, on the management side, managing short-term rentals can be more hands-on, requiring effective marketing, communication with guests, and property maintenance. And because you're going to have people in and out of there so often and so frequently, then cleaning up the property and getting it ready for the next short-term tenant is pretty hands-on. So it would be very smart to have property maintenance or property management to take care of this short-term rental, unless this is just something that you do and you have the time to do that. And something new on the horizon is midterm rentals, typically involving leasing a property for a more extended period than short-term rentals, but shorter than traditional long-term leases. So this could range from a month to several months, but less than a year. So your lease terms is the property owners need to negotiate lease terms that provide flexibility for both parties. So usually this includes traveling nurses or professionals who are in interim or temporary positions, and they need housing for a few months to less than a year. So this midterm rental situation is coming up on the horizon because some people don't want the long-term responsibility, and also the short-term responsibility is a little much with all the cleaning. So this midterm rental is a win-win situation for a lot of people because you don't have all the cleaning, and then you also, this property is not something that you're going to keep tenants in for a long term. So midterm rentals could be the answer to a lot of people's prayers. Okay, so now we're going to talk about commercial real estate. And under this asset class, there are lots of things that go under commercial real estate. So commercial properties are designed for business purposes. So this category includes office buildings, retail spaces, industrial warehouses, and hotels. Commercial real estate often involves longer leases and higher rental income, but can be subject to economic downturns. So if the economy is down, then a lot of times the tenants in these commercial real estate leases aren't able to keep up with the rents because their business is down. So this is why you have to be really careful when you're dealing with this asset class. Now, there are three types of leases, net leases. So the first one is a single net lease, and this is where the tenant pays the base rent and they also pay the property taxes. Then you have a double net lease where the tenant pays the base rent, the property taxes, and the insurance. And then you have a triple net lease where the tenant pays property taxes, insurance, and maintenance costs. And the advantages of this is it allows for direct cost sharing, landlord and tenants have more control over the property. So when they have that triple net lease, the landlord is basically there to collect the rent, and the tenant does everything else. They pay the property taxes, the insurance, and the maintenance costs. So that's a pretty good deal, because that takes a lot of the responsibility off of the landlord. So there are also short-term leases with commercial real estate, typically have a duration of 1 to 3 years. They offer flexibility for tenants and landlords, but may result in more frequent turnover. The advantages, it allows for flexibility in changing market conditions and tenant needs. So if there's a business in your commercial real estate space and their business is booming the first 1 to 3 years and then business goes down, this allows them to move out of your property on a good and on a basis where they are up to date on everything and they're moving out with clean hands is what I'm going to say, which means that their lease term is up and they're out of there. But then you have long-term leases, which can extend for 10 years or more, and they provide stability for both landlords and tenants, but may have less flexibility because it could be a 10 years up to, I've seen 25 years where the lease has been extended. So we want to make sure that when you are doing a long-term lease, that this is like an aristocrat business, which means that they have been around for a very long time. They have the business, they have the capital to keep up with the rent and the maintenance costs and the taxes and insurance. So if you have a long-term lease, you want to make sure that this is a business that has been around for a very long time. And this provides a stable income stream for landlords because it's a long-term lease, and it provides long-term security for the tenants because they're not having to move around often. Like they can stay in one place for a very long time. The caveat for this is that office buildings have classifications like Class A, B, or C, and this is used to denote the quality and amenities of office spaces. So this is letting you know really what kind of neighborhood you're in. Like Class A is the best, Class C is like in the middle. So, and usually a office building with a Class B or C are buildings that could use updates, or you could add value to those buildings. But a Class A building is usually a turnkey where you can just move right into that building. So if you're doing this for investing purposes, usually you want a BRC, something you can add value to, because that's going to allow you to collect on the equity and the appreciation, because of the ARV, the after repair value, is going to be quite extensive. So that's just a little caveat about commercial real estate, and something you might want to look for when you're looking to invest in that. So another part of commercial real estate is healthcare real estate, which are properties such as hospitals, medical offices, and senior living facilities. And I've seen a lot of residential assisted living properties that would fall under healthcare real estate. And the aging population often drives demand for healthcare related properties. And the rents on these healthcare real estate properties is great. Like I've seen one room go for as little as $3,500 a room up to $11,000 a month. So healthcare real estate is something that's very lucrative. And because we have so many baby boomers, it's a great demand for these healthcare real estate properties, because they need help with everyday um, living routines and tasks. So, yeah, these are very lucrative. And then you have mixed use real estate. Mixed use developments combine different types of properties such as residential, commercial, and retail spaces. Can't say that word today, retail spaces within a single project. And this approach aims to create a more dynamic and integrated community. So this building would look like maybe a retail store on the first level, and then on the second level, you may have apartments above the store. So that's why it would be a mixed use, because you're using it for more than one purpose. And then you have specialized real estate, and this category includes niche or specialized properties, such as data centers, self-storage facilities, which also have the classification of A, B, or C. You have student housing and more. So these properties may have unique demands and risk profiles. So now we're going to look at non-traditional real estate. And this is land as an asset class. Investing in land involves purchasing undeveloped or vacant land with the expectation of appreciation or future development. Land can be used for residential, commercial, agricultural, or recreational purposes. So investment considerations: appreciation potential. The value of land can appreciate over time, especially if there is increased demand for development in the area. Development opportunities: investors may benefit from holding land in areas where urbanization or infrastructure development is anticipated. So what they're saying is, if you purchase land and there's going to be development opportunities, say for example a Walmart or some sort of big box commercial business is looking to build next to that land or close to that land, they may want to include your land in their development, which means that they would purchase the land from you in order to include it in their purchase, which could be very lucrative. And also with land, if you develop the land as far as if it needs a septic tank or a well for water on that land, you could develop that land and the appreciation of that land would skyrocket quickly. For example, I told you in another video that we had purchased 4 acres of land and decided to sell it because the covenants and restrictions did not allow us to do what we wanted to do with the land. And in 4 months, that land appreciated double for what we paid for it. So that's why they're saying the value of this land, sometimes it takes time and sometimes it doubles or it appreciates very quickly, depending on how you have developed the land and where the land is located. Now, if this land is somewhere where there's no amenities around it, no communities, no future development opportunities, then you're going to be sitting on that land for a while, and it will appreciate over time, but it may take a longer period of time. And also with the land, like I said before, with the covenants and restrictions, you need to make sure that what you are intending for this land can be accomplished on this land, because those covenants and restrictions can stop you from doing the things that you intended on doing. So that's why it's very important to research when you are investing in land. And the holding cost, unlike rental properties, is lower because of, you don't have a property or building to maintain. So basically you have property taxes and insurance, and then you have to make sure that you get the land mowed or cut like once a month, because usually on that land, unless it's just in a very lush place, the grass doesn't grow like that. So when we had that 4 acres, we generally were able to get the land manicured or mowed like maybe once a month. So that is a land asset class. And there are lots of things that you can also put on the land besides houses or multifamily houses. For example, there are solar farms that you could put on the property, and that's where the city or the state, they will bring solar panels and they will put it on the land, and usually they will lease the land for like 25 years, and a lot of times they will pay that up front. So you can have solar farms, you can have timber farms where you just growing trees for the wood. There are lots of things that you can do with the land. You could also trucker parking, like you could develop it for parking for big trucks. Um, there are lots of things that you can do with that, and it can be lucrative. And also, you don't have as much maintenance on this asset class. All right. So the next one is REITs, Real Estate Investment Trust. And these are not a traditional property type, but these are investment vehicles that allow individuals to invest in a diversified portfolio of real estate assets. REITs can focus on various property types, providing investors with a way to gain exposure to real estate without directly owning property. So these REITs have liquidity, which means that you can sell them like stock if you're investing in them. And also, they are considered a pass-through entity because the income that they have or earn is passed through, 90% of it is passed through to the shareholders. So this could be a really good way to get into the real estate investment game without actually owning any real estate. So that's another way of doing it with a little bit of money and still get the benefits of investing in real estate. So those are all the real estate classes that we're going to look at today. So in summary, investors choose these different real estate asset classes based on their risk tolerance, investment goals, and market conditions. Short-term rentals and mid-term rentals can provide more immediate cash flow, but may involve higher management efforts. Land investments, on the other hand, often require a longer-term perspective and involve considerations related to development potential and market trends. So all of these different asset classes are um, real estate investments that where you can diversify your portfolio by having all of them, or you can have a mixture of them, or you can have a basket of them. So there are lots of different ways where you can diversify your portfolio and still be successful in real estate investing. So thank you for joining me today. And if you have not hit the like, subscribe, or notification bell, please do that. And so that other people can see this content. I'm Dr. Shelley Brown. I do have a course on udemy.com entitled Essentials of SFR Investing Strategies Made Easy. And I will put that in the first comment so you can just click on it and go right to the site. All right, so I am going to stop sharing. And I hope you got a lot of value from this video. I hope you took lots of notes so that you can look at your portfolio or the portfolio that you hope to have and see which way you want to actually start investing or how you can diversify the portfolio you already have. Okay, so I will see you next time. Goodbye.